or not. It's standard practice.
Right, but, they can't be too obvious about it. In other words, Bernanke or the CEO of Motorola can't go buy it in his own account, but he might tell his brother who tells his son-in-law, and he does it in a manner which is hard to determine it was really a tip. You see, so they do those kind of things, and the SEC say, well, we don't know who bought those calls, or we don't know who bought the puts, or maybe they do, and they know the guy who really tipped is too big to be prosecuted. Just like Mack, who still is, I believe, the CEO of Morgan Stanley. There was a guy, the SEC was trying to take his deposition about a series of what he thought was inside information. This guy, who was a lawyer at the SEC, wanted to take his deposition, and the SEC fired him because he was too big to be prosecuted as the CEO of Morgan Stanley. Okay? And there was a congressional investigation, but he was never put under oath because he wanted to take the deposition to get to the truth of the matter. And so he never did give the deposition. You see, now, if it was you or me, they'd force you to take the deposition, and if you want to defend yourself, you either have to tell them the truth or take the fifth. You see? And so big guys who are CEOs and stuff like that, they don't want to go into a deposition and have to take the fifth. That doesn't make them look too good.
Can you go back for a minute here to the volatility index? I want you to explain what it is and what it does again, because I feel like we may have lost some of the audience members.
All right. The volatility index is an index that's created by the Chicago Board Options Exchange, and it's the value of certain out-of-the-money puts and calls on the Standard & Poor's 500 index future. In other words, there's an index of 500 different companies, all the large companies, in the Standard & Poor's index, and it's more or less a very good barometer of what the market is doing. On the other hand, you have the Dow Jones Index, which is just 30 companies and has a lot of oil companies. It's more stable. But you have the Standard & Poor's Index of 500 stocks. And then you have the futures on the Standard & Poor's Index. In other words, if you want to be in the market, you want to be diversified into 500 different stocks, you can do it very efficiently by buying futures on the Standard & Poor's Index. Okay? Now, there's actually options. There's puts and calls on the index. And there's some puts and calls that are in the money, some are at the money, and some are out of the money. Now, they've created what they call the VIX, which is a compilation of certain out-of-the-money calls and out-of-the-money puts.
What does out of the money mean?
Out of the money means that if you have the right to buy the stock or buy the index at a specific price, for example, if you have the right to buy a stock at 100 and the stock's trading at 75 or 80 or 85 or 90, then those are the calls that give you the right to buy the stock at 100, or what we call out of the money. If you have the right to buy the stock at 100 and the stock's trading at 125, those calls are called in the money. In other words, you have the right to buy something at 100 and you can go sell it tomorrow at 125. All right? Now, if you have the right to buy it at 100 and it's still at 75, those are out of the money, and nobody's going to exercise their right to buy the stock at 100 when it's trading at 75 because they're going to lose $25. So you have out-of-the-money calls and out-of-the-money puts. Puts give you the right to sell the stock at a specific price throughout a specific period of time. If the stock is trading at 75 and you have the right to sell it at 100 because you have the puts. In other words, if you own puts and you have the right to sell it at 100 and it's trading at 75, those puts are in the money. Okay? If you have the right to sell the stock at 50 and the stock's trading at 75, those puts are called out-of-the-money puts. The puts and the calls that are out of the money, in other words, they don't give you the right to exercise right away and then sell at a profit, but it's all based on the prospects of the stock going up. You can buy out-of-the-money puts quite cheap. You know, just like in Bear Stearns, when the stock was 70, there was people who were buying the puts with 5 days to expiration with the right to sell the stock at 20 when it was trading at 70.
That would tip me that that's inside information.
Right. So there was lots of those buying. Okay. But there was nobody charged with insider trading in Bear Stearns. even though you had all of this commotion about naked short selling and manipulation of the stock, I've heard Mr. Christopher Cox talk about they're going to investigate naked short selling or guys who manipulated or insider trading in Bear Stearns. But, it's been over 3 years.
Okay, now wait, I want to bring you back. So I want you now to explain why the volatility index exists.
Okay. The idea is to give an indication as to what the market is suggesting about the future of the market and its expected volatility. When the volatility index, which is a compilation of the out-of-the-money calls and the out-of-the-money puts on the Standard & Poor's index futures, if it goes up, it generally implies there's quite a bit of uncertainty and expect volatility.
But do you think it's an organic, accurate mechanism given the fact that there's this synthetic manipulation?
Well, I think there's more significance ascribed to the VIX than it's worth. But it is a method, and usually what happens is that when the market goes down, the VIX picks up, and usually you get some swings up and down, and then if the VIX goes up some more, the market goes down some more. Okay, but if the market goes up substantially, the VIX goes down substantially. And people try to ascribe the idea that when that VIX goes up, it's time to panic. And a lot of times it's right, because when that VIX goes up, that means people are buying puts or buying calls, or there's an expression of fear. Okay? Now, I was talking to an old friend of mine yesterday, and he says he's in contact with market makers who are in the VIX pit every day, making bids and offers in the VIX options. And they tell him it's widely known that Goldman Sachs manipulates the value of the VIX every day. And he says that the exchanges know about it and the SEC knows about it. Now, those guys are guys that are not going to come out there because they're working for firms, and it's kind of like understood in the industry that if you know about somebody stealing, you keep your mouth shut.
Don't you think it's also true for Standard & Poor's? I remember 1.5 to 2 years ago, right before the market crash, there were articles coming out about the fact that Standard & Poor's was implicated for conflicts of interest with upgrading paper and giving a higher credit rating to certain companies and being paid to do certain things. Of course, everybody could say this is alleged, but it feels to me like even Standard & Poor's is not an organic mechanism. It still involves human beings. It still involves why a company has a AAA versus a AA rating. Could be many things. Maybe certain people in Standard & Poor's don't want to play along with certain groups unless certain things are done. We don't know that. And I'm not a pessimist.
I think that Standard & Poor's gave AAA ratings to a lot of these credit default swaps and things like that.
Exactly.
That were backed by subprime mortgages, you see. And the people or pension funds like CalPERS and the Louisiana State Employees Retirement Fund, they might have been restricted to buying AAA-rated securities. And so they created these funds, which were baskets of subprime mortgages, and sold them as AAA rated because they had Standard & Poor's rating them as AAA.
Understood.
But it turned out they weren't AAA. You see, there's a lot of people say that Standard & Poor's was negligent or were being paid to do the reports by the guys who wanted the AAA rating. Now, nobody's been charged with a crime there.
So it sounds like you're a whistleblower.
Well, I was thinking of actually starting a little organization since I have some market maker friends and things like that. And I actually talked to the SEC, and they said they haven't paid out any money yet, but it only started August 12th. So, the question is it worth it to try to do it? Will they, in fact, change their attitude? But if you're really looking for it, and you got guys looking for cheating, you can probably find it pretty regularly.
Sounds like you can find it very quick. I want to go back to naked short selling. And I want you to explain what it is and why it's relevant in this whole context of what's going on.
All right. There are two types of short selling. One is regular short selling, and the other is what they call naked short selling. And we're restricting ourselves to talking about stocks right now. Okay?
Okay.
Now, regular short selling is if you borrow some shares at